On a seemingly ordinary day in January 2026, the Japanese yen just pulled off something that should terrify anyone paying attention to global markets. In less than 24 hours, it surged 1.6% against the dollar. That's its biggest single-day jump in nearly 6 months. Now, you might be thinking, so what? Currencies move all the time. But here's what makes this different. This wasn't driven by good economic news or some brilliant policy decision. This happened because traders got spooked by the mere rumor that Japan might intervene to save its collapsing currency. Think about that. The yen didn't rally because it got stronger. It rallied because markets are so fragile they're now front-running panic moves from desperate central banks. And if you think this is just Japan's problem, you're missing the bigger picture. What's happening to the yen right now is a warning shot across the bow of every fiat currency system on the planet. By the end of this video, you'll understand why this obscure currency move could reshape global markets, spike inflation, trigger a bond crisis, and quietly make silver one of the most underrated assets nobody's talking about. Stay with me, because what happens next could change everything. Part 1. Japan's currency. Quietly hits a breaking point. Let's set the scene. January 2026. Currency traders around the world are watching their screens when suddenly, the Japanese yen starts moving. Fast. We're talking about a 1.6% rally in a single trading session, pushing the yen to 155.90 per dollar. That's the strongest it's been since December. For context, major currencies like the yen don't usually move like this. These are massive liquid markets. A move this big, this fast, means something serious is happening behind the scenes. So what triggered it? Here's where it gets interesting. Traders started reporting that the Federal Reserve Bank of New York had conducted what's called a rate check with major banks. Now, if you're not familiar with central bank operations, a rate check sounds boring. It's not. When the New York Fed starts calling around to banks asking about rates, it's usually because someone is preparing to do something big in the currency markets, and in this case, that someone is Japan. The speculation immediately spread through trading desks. Japan is about to intervene. They're going to buy yen to prop up their currency. And just like that, the market moved. Not because intervention actually happened, but because traders believed it might happen. That's the level of fragility we're dealing with here. But let's back up and understand what currency intervention actually means, because this is crucial to understanding why this matters. When a country's currency gets too weak, it creates problems. Imports become more expensive. Inflation rises. People's savings lose value. So central banks can step into the foreign exchange market and literally buy their own currency, using their reserves of foreign currencies like dollars. This increases demand for their currency, which pushes the price up. It's market manipulation, but it's legal when governments do it. The technical term is foreign exchange intervention. Japan knows this playbook well. They last intervened in 2024 when the yen was sliding toward levels that threatened economic stability. Japanese officials spent billions buying yen to stabilize it. And here's the thing. It worked. Temporarily. But now, just over a year later, they're facing the exact same problem again. The yen had been sliding steadily before this sudden surge. It was creeping back toward those 2024 levels that forced them to act before. So when Japan's finance minister and the country's top currency official started issuing warnings to speculators earlier this month, traders knew exactly what was coming. They'd seen this movie before. The warnings escalated, the rhetoric got sharper, and then came the New York Fed rate check. That was the signal. Markets don't wait for official announcements anymore. They front-run the intervention. And that's what makes this moment so revealing. The yen didn't strengthen because Japan's economy suddenly improved. It didn't rally because of strong exports or rising productivity or anything fundamental. It rallied because of fear. Fear that authorities were losing control. Fear that intervention was imminent. Fear that the currency system itself was showing cracks. This is what financial fragility looks like in real time. When a major reserve currency, held by central banks around the world, used in trillions of dollars worth of trade, can spike 1.6% on nothing but intervention rumors, you're watching a system under stress. The yen is supposed to be stable. It's one of the world's major currencies. It's a safe haven asset during global turmoil, but right now, it's acting like a currency in crisis. Here's the deeper issue that nobody wants to talk about. Markets are now reacting to the fear of intervention, not actual intervention. That's a critical distinction. In a healthy currency system, you shouldn't need intervention. Market forces, economic fundamentals, trade flows, these should determine exchange rates. But when a currency becomes so volatile that just the possibility of government action can move it nearly 2% in a day, you're looking at a system that's lost the confidence of participants. And confidence is everything in currency markets. Money, at its core, is a collective belief system. We believe this piece of paper or this digital entry has value because everyone else believes it too. But when that belief starts cracking, when people start questioning whether a currency can maintain its value, the whole thing can unravel fast. Japan's situation reveals a deeper monetary fragility that extends far beyond just the yen. They're trapped in a policy corner with no good options, and the fact that they're having to resort to warnings, threats, and market intervention just to keep their currency from collapsing tells you everything about how precarious the situation really is. This isn't a one-off event, this is a warning sign. And if you understand what's driving this crisis, you'll understand why the implications reach far beyond Japan's borders. Part 2. The hidden monetary trap. Why the yen keeps sliding. So why does the yen keep weakening in the first place? To understand that, you need to understand the trap Japan has walked into. And it's a structural problem built into the global monetary system itself. Before this dramatic surge, the yen had been in a steady, grinding slide. Week after week, it was weakening against the dollar, pushing right back toward those 2024 levels when Japan had to intervene. The pattern is clear. Intervene, stabilize temporarily, then watch the currency weaken again. Rinse and repeat. What's causing this persistent weakness? Interest rate differentials. Japan has kept rates near zero for decades to fight deflation and encourage spending. Meanwhile, the United States has significantly higher interest rates. When you can earn more interest in dollars than in yen, investors sell yen, buy dollars, and put that money in US assets where they can actually earn a return. This is basic capital flow economics. Money flows to where it's treated best. The interest rate gap creates relentless pressure on the yen. It's like trying to hold back water with your hands. Eventually, the pressure becomes too much. Here's where the trap snaps shut. Japan can't just raise interest rates to stop the yen from weakening. Why? Because their entire economy is built on cheap money. The Japanese government has debt to GDP ratios above 200%. If they raise rates significantly, the cost of servicing that debt explodes. It could trigger a fiscal crisis that makes the currency problem look minor. So they're stuck. Keep rates low and watch your currency weaken, or raise rates and potentially implode your government finances. This is the hidden monetary trap happening right now. But there's another layer. Market psychology. Traders can see the trap Japan is in. They know the fundamentals favor a weaker yen, so they start betting against it, shorting it, pushing it lower. When enough traders do this, it becomes self-fulfilling. The yen weakens because everyone expects it to weaken. This is where intervention rumors become so powerful. When traders hear Japan might intervene, they suddenly face the risk of being on the wrong side of a massive government action. Japan has trillions in foreign exchange reserves. If they intervene aggressively, they can inflict serious pain on anyone betting against the yen. So traders close their positions, buy back the yen, and boom, 1.6% surge in a single day. But this is just traders front-running the intervention. They're not buying yen because they believe in it. They're buying it because they're afraid of getting crushed. The moment that fear subsides, the fundamental pressure returns. The interest rate differential is still there, and the yen starts sliding again. This is why the New York Fed rate check matters. The Fed doesn't casually call around for fun. A rate check typically happens when there are concerns about market volatility, about disorderly moves, about the risk that something might break. The fact that they're checking rates in the yen market tells you that financial authorities are watching this with serious concern. Intervention speculation itself has become a market-moving force. The mere possibility of government action is now more impactful than actual economic data. We've reached a point where markets trade on policy fear rather than economic reality. That's not healthy. That's a sign that trust in the system is eroding. Japan is losing control of the currency narrative. Every warning, every stern statement admits they're worried. And that admission feeds the cycle. Markets test boundaries. They push the yen lower. Japan warns them. Markets push harder. Japan intervenes. Brief stabilization. then the cycle starts over. This is exhausting and expensive. Intervention costs billions to move major currency markets, and you can only fight fundamentals for so long. If economic forces favor a weaker yen, and they do, then intervention is just buying time, not solving the problem. How long can Japan keep this up? How many times can they intervene before markets stop taking them seriously? We might be approaching that breaking point, and if we are, what comes next could be far more dramatic. We could be looking at a full-blown currency crisis, where authorities lose their ability to stabilize it. That's the trap. Japan can't raise rates without destroying their fiscal position. They can't keep rates low without destroying their currency. And they can't intervene forever without depleting reserves and losing credibility. There are no good options, only choices about which kind of pain to accept. Part 3. Market Intervention. Theatre, what traders are really watching. Let's talk about what's actually happening in trading rooms around the world, because this is where you see the real dynamics of currency crisis play out. When that yen surge hit, it wasn't a slow, steady move. It was violent, sudden. The kind of move that triggers alarms on trading desks and causes people to literally shout across floors asking what the hell just happened. A 1.6% intraday move in a major reserve currency is not normal. The yen is one of the most heavily traded currencies on the planet. It's in the top 3 globally by volume. When you're talking about markets this large, this liquid, movements are usually measured in fractions of a percent. A 1.6% swing is seismic. It's the kind of move that can wipe out hedge funds, trigger margin calls, and force massive position unwinding. And it happened on speculation. Not fact. Speculation. Traders reacted instantly to intervention rumors, which shows just how fragile confidence really is. Nobody wanted to be the last person holding a short yen position if Japan was about to dump billions into the market. So they all rushed for the exit at the same time. This is the intervention theatre we're watching. It's a game of chicken between traders and authorities. Traders push the yen lower, testing how far they can go. Authorities issue warnings, trying to scare traders into backing off without actually having to spend money on intervention. Sometimes the warnings work, sometimes they don't, but each round reveals more about the power dynamics at play. The New York Fed rate check is a particularly important signal in this theatre. When the Fed gets involved, even just by making calls, it suggests coordination between US and Japanese authorities. It suggests that the currency moves are significant enough that they're showing up on systemic risk radars. Central banks talk to each other constantly, but they don't usually make their communications this visible unless something important is happening. Rate checks serve a specific purpose. They're essentially the Fed asking major banks, what would it cost to do a large currency transaction right now? What's the market depth look like? How much volume could we move without causing disruption? These are the questions you ask when you're preparing for possible action, or when you want markets to think you're preparing for action. And that ambiguity is intentional. Maybe Japan is about to intervene. Maybe they're just rattling the saber. Traders have to make decisions with incomplete information, and that uncertainty itself becomes a tool of policy. Japan's officials issuing repeated warnings throughout the month shows escalating policy stress. Think about the progression. First, the yen weakens. Officials monitor quietly, then it weakens more. They make public comments about watching markets closely. It keeps weakening. They issue stronger warnings about taking appropriate action. Still weakening. They explicitly warn speculators, and finally you get the rate check that triggers the market reversal. This escalation ladder tells you that Japan is increasingly uncomfortable with where the yen is trading. Each step up the ladder is an admission that the previous step didn't work, and each admission makes the next step less credible. The 2024 intervention sets a crucial precedent. It proves that Japanese authorities will actually pull the trigger. They're not bluffing. They've shown they're willing to spend real money to defend the currency when it reaches certain levels. This makes the warnings more credible than they otherwise would be. Traders know that if they push too far, Japan will act. But precedent cuts both ways. The 2024 intervention also showed that even when Japan does act, the effect is temporary. The yen stabilized for a while, but here we are again, facing the same problem. That tells traders that intervention doesn't solve the underlying issue. It just creates a temporary pause, which means the smart money might actually view intervention as a buying opportunity, wait for Japan to prop up the yen, then short it again once the intervention effects wear off. This is the brutal logic of currency markets. They're not sentimental. They follow the path of least resistance and maximum profit. And right now, that path points toward a weaker yen over the medium term, regardless of how many times Japan intervenes. But here's what really matters for global markets. Currency intervention doesn't happen in a vacuum. When Japan intervenes, they're not just affecting the yen-dollar exchange rate. They're triggering capital flows that ripple through the entire global financial system. If Japan is buying yen, that means they're selling dollars. Those dollars have to go somewhere. They affect bond yields, stock prices, commodity markets. Everything is connected. This is why a major central bank intervening can trigger global capital reallocation. Suddenly, portfolio managers around the world have to recalculate their positions. Hedge funds have to adjust strategies, pension funds have to rebalance, and all of this happens fast, which creates volatility in markets far beyond just currencies. The yen is becoming a global volatility trigger. That's the key insight. What happens to the Japanese yen now matters for markets everywhere, because the moves are so large, so sudden, and so driven by policy uncertainty rather than economic fundamentals. Traders in New York, London, Shanghai, they're all watching the yen because they know it's an early warning system for broader market stress. And that brings us to the uncomfortable truth that nobody in official circles wants to acknowledge. The yen crisis is revealing that we're operating in a global currency system held together by increasingly desperate policy interventions and increasingly fragile market confidence. The theatre of warnings and rate checks and sudden surges, that's not the sign of a stable system. That's the sign of a system under pressure, where authorities are running out of good options and markets know it. Part 4. The Domino Effect. What a yen crisis means for global markets. Now let's talk about what happens if this yen situation actually spirals into a full crisis. Because the implications go way beyond Japan. The yen isn't just some random currency. It's woven into the fabric of global finance in ways most people don't understand. And if it unravels, it could pull a lot of other things down with it. Start with something called the carry trade. This is one of the most popular strategies in global finance, and it depends entirely on the yen staying weak and Japanese rates staying low. Here's how it works. Investors borrow yen at basically zero interest, convert that yen into dollars or other currencies, and then invest in higher-yielding assets around the world. As long as the yen stays weak or weakens further, this trade prints money. But historically, yen weakness has fueled these carry trades to absolutely massive scale. We're talking trillions of dollars in positions built on the assumption that the yen will remain weak and stable. This borrowed yen money flows into everything: emerging market bonds, US stocks, real estate. It inflates asset prices globally. It creates bubbles. And here's the dangerous part. If the yen suddenly strengthens, like it did with that 1.6% surge, the carry trade goes into reverse. Fast. Investors who borrowed yen now see their debt becoming more expensive. They have to sell their other assets to buy back yen and close out positions before they lose everything. This selling pressure hits markets all at once. Stocks drop. Bond yields spike. It's a global margin call triggered by a single currency move. We've seen this before. Back in 2008, during the financial crisis, there was a massive carry trade unwind when the yen suddenly strengthened. It amplified the market crash. The yen didn't cause the financial crisis, but the carry trade unwind made everything worse. That's the kind of systemic leverage we're dealing with here. A sudden yen strengthening can unwind global leverage trades in a matter of days. The speed is what kills you. When everyone tries to exit the same trade at the same time, liquidity evaporates and prices gap violently. This is why central banks globally monitor yen moves as a systemic signal. The Bank of England, the European Central Bank, the Federal Reserve, they all care about the yen because instability in the yen market can translate directly into instability in their own financial systems. Then there's another angle. Japan is one of the world's largest holders of foreign bonds, particularly US treasuries. Japanese institutions, banks, insurance companies, pension funds hold trillions of dollars worth of foreign assets. If you're a Japanese pension fund and Japanese interest rates are zero, you go abroad. You buy US government bonds paying 3 or 4%. But what happens if the yen crisis forces these institutions to bring money back home? What if they need to repatriate capital to shore up balance sheets or meet domestic obligations? They'd have to sell those foreign bonds. They'd have to sell US treasuries. And if Japanese holders start dumping US bonds at the same time that the Federal Reserve is no longer buying them, who's left to absorb all that supply? Forced repatriation of capital could spike global yields. When bond prices fall, yields rise. And when yields rise, everything gets more expensive. Mortgages get more expensive. Corporate borrowing gets more expensive. Government deficits become harder to finance. It's a tightening of financial conditions that can slow or even crash the global economy. This is the domino effect. The yen weakens, Japan intervenes, the intervention fails to hold, carry trades unwind, asset prices fall, Japanese institutions repatriate capital, foreign bond yields spike, financial conditions tighten, economic growth slows, and suddenly you're in a global financial crisis that started with something as boring sounding as yen volatility. The deeper message here is that foreign exchange intervention itself signals deeper systemic fragility in fiat currency regimes. Think about what intervention really means. It means the natural market price of a currency is unacceptable to authorities. It means they have to override market forces with policy action. It means the fundamentals are so bad that without intervention, the currency would collapse. That's not a sign of strength. That's a sign that the currency system itself is unstable. And when you have to repeatedly intervene in the same currency for the same reasons, you're admitting that you haven't fixed the underlying problem. You're just papering over the cracks and hoping they don't widen. The yen crisis is really a crisis of confidence in fiat monetary systems. If a major developed economy like Japan can't maintain currency stability without constant intervention threats, what does that say about the durability of the global fiat system? What does it say about the dollar, the euro, the pound? They're all built on the same foundation. Government decree and collective belief, and if that belief starts cracking in one major currency, it can spread to others. This is not just Japan's problem, it's a global liquidity risk. The yen situation is a stress test for the entire international monetary system, and right now, the system is showing serious signs of strain. Markets are fragile, policy options are limited, debt levels are astronomical, and the tools that central banks relied on for decades are showing diminishing returns. What we're watching is the endgame of a monetary experiment that started when Nixon closed the gold window in 1971. For over 50 years, we've had a purely fiat system with no hard anchor. But when confidence starts to crack, when interventions become routine, when major currencies can move 2% on rumours, you have to ask, how much longer can this system hold together? Part 5. Silver's quiet role in currency stress. So where does silver fit into all this? And before you roll your eyes thinking this is going to be some apocalyptic buy silver or die pitch, hold on. This is actually about understanding silver's unique position in moments of currency volatility. And it's not about doom. It's about diversification and insurance in a system showing serious stress cracks. Here's the thing about currency volatility. When people start losing confidence in paper money, they naturally look for alternatives. Not because they're paranoid, but because it's rational. If you watch a major currency like the yen swing wildly, if you see central banks forced to intervene repeatedly just to maintain stability, you start thinking about assets that aren't dependent on government policy or central bank credibility. That's where tangible assets come in, and silver has historically been one of those assets. When fiat systems show stress, hedging demand for tangible assets often increases. People want something real, something physical, something that can't be printed or manipulated by central banks. Silver is interesting because it sits in this unique middle ground. It's not quite gold, it doesn't have the same monetary history or central bank demand, but it's also not just an industrial metal like copper. Silver has been used as money for thousands of years. That monetary heritage doesn't just disappear because we switched to paper money. So silver functions as both an industrial metal and a monetary hedge. That dual nature gives it interesting dynamics during currency stress. On the industrial side, silver is critical for electronics, solar panels, and medical applications. Demand is real and growing. But on the monetary side, silver serves as a portfolio diversifier and a store of value when confidence in fiat currencies wavers. The yen instability we're seeing could influence Asian precious metals demand. Japan, China, Korea, Taiwan, these are massive markets for precious metals. Asian investors have a long cultural affinity for gold and silver as stores of wealth. When currency stress hits the region, you often see increased buying of precious metals as a hedge. It's not panic buying, it's prudent risk management. And here's the broader point. Foreign exchange intervention and repeated currency crises are signals of broader fiat uncertainty. When you see what's happening with the yen, the intervention threats, the massive daily swings, the desperate warnings from officials, it tells you something about the stability of the entire monetary system. It's a reminder that currencies are not stable stores of value. They're policy instruments that can be manipulated, devalued, and destabilized. That realization leads investors to diversify. Not to abandon currencies entirely, that would be impractical, but to hold some portion of wealth in assets that aren't subject to the same policy risks. Silver fits that role. It's affordable compared to gold, so you can accumulate meaningful positions without massive capital. It's liquid. You can buy and sell it easily in markets around the world. And it has that monetary heritage that gives it value beyond just industrial demand. But let's be clear, silver is not a panic trade. It's not a "the world is ending, buy silver and hide in a bunker" situation. Silver is better understood as a systemic insurance narrative. When you buy insurance on your house, you're not predicting your house will burn down. You're acknowledging that bad things can happen, and it's wise to have protection. Silver works the same way in a portfolio. During periods of currency volatility, silver tends to attract attention as a diversification tool, not as a replacement for currencies or stocks or bonds, but as a complementary holding that behaves differently. When confidence in fiat systems wavers, silver often performs well. When inflation picks up because of currency weakness, silver often performs well. The current yen situation fits both conditions. We have clear currency instability and inflation risks from weak currencies making imports more expensive. In that environment, having some exposure to silver as part of a diversified portfolio makes rational sense. And here's something most people don't realize. The silver market is actually quite small. Total above-ground silver reserves are limited. Annual production is measured in the hundreds of millions of ounces, not billions. If even a small percentage of global capital decides to diversify into silver during a currency crisis, it can move the market significantly. This isn't about silver going to the moon or replacing currencies. It's about understanding that in a world of increasing monetary uncertainty, assets with tangible value and limited supply have a role to play. Silver is one of those assets. It's been used as money for millennia. It has real industrial demand. It can't be printed by central banks. And it tends to hold value when confidence in fiat systems erodes. So when you watch the yen crisis unfold, when you see central banks resorting to intervention, it's worth thinking about what that means for your own financial positioning. Not in a fearful way, but in a thoughtful risk management way. Silver represents a small, liquid, accessible way to diversify away from pure fiat exposure. And sometimes, in uncertain times, that's exactly what you need. Part 6. The human cost of a currency crisis. Let's zoom out from trading desks and central bank policies and talk about what this actually means for real people. Because behind every currency chart, behind every intervention statistic, there are millions of human beings whose lives are affected by these abstract financial forces they don't control and barely understand. When the yen weakens, it's not just a number on a screen, it's direct economic pain for Japanese households. A weak yen makes imports more expensive, and Japan imports a lot. Energy, food, raw materials, all of it comes from abroad and all of it is priced in foreign currencies. When the yen loses value, those imports cost more. Companies pass those costs on to consumers, and suddenly everyday life gets more expensive. The cost of food goes up because Japan imports much of its food supply. A weak yen means wheat costs more, meat costs more, dairy costs more. When the yen weakens, grocery bills rise. That's inflation in the most direct, painful form. Energy costs spike too. Japan imports nearly all of its fossil fuels. A weaker yen means higher electricity bills, higher heating costs, higher gasoline prices. These aren't optional expenses. People have to absorb the higher costs and cut back somewhere else, and that's where the real suffering begins. When inflation erodes purchasing power, people have to make hard choices. Do you buy less food? Do you skip medical appointments to save money? Do you delay necessary purchases? These decisions compound over time, degrading quality of life in ways that don't show up in GDP statistics. Workers and retirees are especially vulnerable. Most workers don't get automatic cost of living adjustments when the yen weakens. Their wages stay flat while their expenses rise. That's a direct cut in real income. They're working the same hours for money that buys less. Retirees on fixed incomes are even more exposed. If you're living on a pension calculated years ago, and the yen has lost significant value since then, your monthly payment stays the same but buys less every year. For elderly people on tight budgets, this can mean choosing between food and medicine. Foreign exchange instability directly pressures wages and savings in ways that create long-term damage. When companies face higher import costs, they freeze wages, cut benefits, or lay off workers. So you're dealing with both higher prices and stagnant or falling income. It's a double squeeze that devastates household finances. And if you spent decades saving money in yen, and the currency loses 20 or 30% of its value, you just lost a huge chunk of your wealth through no fault of your own. Government intervention attempts signal that authorities know this is happening and they're concerned about public economic stability. When too many people are struggling to afford basic necessities, you get social unrest. You get political instability. So when Japan's finance minister issues stern warnings about currency speculation, he's trying to prevent a situation where millions of Japanese citizens suffer from currency collapse. Currency volatility affects food, energy, and essential goods costs in immediate, tangible ways. When a mother has to choose cheaper, less nutritious food because the yen weakened, that's a human cost. When an elderly person keeps the heat off longer in winter because energy got more expensive, that's a human cost. When a family cancels a modest vacation because currency instability eroded their purchasing power, that's a human cost. Behind every foreign exchange chart are millions of households trying to get by, trying to save for the future, trying to give their kids a better life. When currency systems fail, when intervention becomes necessary just to prevent collapse, those households pay the price, not the traders, not the central bankers, regular people who never asked for any of this and have no power to stop it. That's the human cost of a currency crisis. So let's bring this all together. What started as a seemingly technical story about the yen surging 1.6% in a day is actually a window into something much bigger and much more fragile than most people realize. The facts are clear. The Japanese yen just staged its biggest one-day surge in nearly 6 months because traders speculated that intervention was coming. Not because intervention happened, because it might happen. Markets reacted before any policy action, front-running the intervention based purely on a Federal Reserve rate check and warnings from Japanese officials. When rumors move currencies more than fundamentals, you're watching a system under severe stress. Japan's 2024 intervention proves this is an ongoing structural issue, not a one-time event. They intervened then, it worked temporarily, and now they're facing the exact same problem again. That pattern, intervene, stabilize briefly, then slide again, that's a currency in long-term decline that authorities can only pause, not reverse. For global investors, foreign exchange volatility should be monitored as a systemic risk signal. Currency stress often precedes broader financial crises. It's an early warning system, and right now that system is flashing red. This is where silver enters as a rational diversification tool. When fiat systems show this level of instability, it makes sense to hold some assets that aren't tied to government monetary policy. Silver isn't a panic trade or a bet on collapse, it's a hedge. An asset with thousands of years of monetary history that can hold value when confidence in paper currencies erodes. The insurance logic is simple. Protection is cheap relative to potential loss. But here's the bigger story. This yen crisis is a preview of what happens when a purely fiat monetary system runs out of road. The yen is just the canary in the coal mine. It's showing stress first because of Japan's specific circumstances, but the underlying dynamics apply everywhere. The dollar, euro, pound, yen all face similar pressures. What we're watching is the late stage of a monetary experiment where governments believed they could manage currencies with no constraints. For decades it seemed to work. But now the contradictions are surfacing. The debts are too high, the interventions are becoming more frequent, and confidence is eroding. So pay attention to what's happening with the yen, not because you're a currency trader, but because it's a real-time case study in monetary fragility that will likely play out in other currencies in the years ahead. The stability we've taken for granted is maintained through increasingly desperate policy interventions, and that can't continue forever. This is the crisis nobody is talking about. But maybe it's time we started.